I've found that, most people haven't done a lot of thinking about this or haven't done a lot of thought process prior to like when we have to, just because the chaos of medical school is so busy, and then we're getting to residency, and it's just like so many other things to do. So let's take a pause and think about our finances a little bit. So Brenda Bailey. I'm one of the internal medicine and pediatrics hospitalists at Loyola. So I participate in all hospitalist service for pediatrics and general medicine. And I started doing this talk after I had done a ton of research just to like get myself organized. So I am not an expert. I did not major in finances in undergrad. I did biology, like probably half of people here. So I'm completely self-taught, but I still think that there's some things that I can help explain. Okay, so objectives for the talk are to just give you guys some basic financial knowledge, give some advice on what to think about when you start getting a bigger paycheck after residency, and give you some confidence, right? That's really the goal, is to give us some confidence on going forward. I don't know if I can see the chat from the presentation mode, but I'll take a look at it every now and then. But feel free to interrupt me. I know with Zoom lectures, it's easy to just kind of get into the focus mode, and there is a lot of information, but I'll take a look at the chat, and we should finish early and have time for questions.
And I can monitor
Okay,
the chat for you also.
Okay, that'd be great. So real quick about me. I did my medical school at UC Davis. I graduated in 2011. I came to Loyola for residency. I had 2 kids in residency. So there's kid number 1 with my gorgeous husband, and child number 2. So there she is. I'm not sure that is a plan for everybody, but it worked for us. And then right towards the end of residency, I had to take some personal time off, and you should really just read that as accruing more debt. And then I'm a med peds hospitalist. I then had a 3rd child, and there he is, that spoiled baby he is. My husband is a stay-at-home dad. He's a Marine Corps veteran, but essentially I am the sole provider for everybody, including our animals. And so I really just had to get organized and know what I was doing with our finances, because it's just all me. Okay, so why am I here? Because in medical school, as you know, by this point, you learn about medicine and not necessarily like any other life skills. Doctors start earning money much later in life than our peers that maybe graduated college with us. Most of us will have a high negative net worth coming out of medical school. And if you're like, hold on, I feel like I'm a doctor, like, won't I be rich? It's like, no, because of debt, right? Most of us, if you're listening to this talk, you probably have some debt. So what are the classic financial mistakes? And so one is actually paying off student loans in the full 20 to 30 years, buying a home too early, or buying too much house, so just more than what you can afford for your finances, loaning money out to family and friends since your paycheck is bigger, not preparing for the increase in taxes, not living within your means, not saving enough, getting divorced. I'll talk more about that later. And then not having enough insurance. So disability, term life insurance, and umbrella insurance is kind of what I'm going to focus on, and I'll get to that in a bit. So vocab, and you guys know this maybe better than any other group that I usually talk to, that sticks and stones may break your bones, but words leave psychological wounds that will never heal. So let's get to the vocab. Hopefully it won't be that bad. Taxes, right? So this is W-2, your W-2. This is standard when you are an employee for something. Your employer submits your W-2, your taxes, to the IRS. So this is all of your annual wages and what your taxes were withheld. Not sure if everybody knows this, but you can actually adjust how much taxes are withheld out of your paycheck. So if you know that you're going to get a certain amount of like deductions because you have kids, you can either get that money earlier in your paycheck, or you can pay the government with it later. It's all going to even out around tax time. But that they're going to report what is currently coming out of your paycheck to the IRS. The other big one that is relevant for us is called a 1099, and this is miscellaneous tax form. So this is for self-reporting. So if you're not an employee, you're an independent contractor, this is where you're going to report that money. So it could be rent, it could be royalties, it could be self-employment. For doctors, it's a lot of times independent contractors. So sometimes emergency room contracts will be, there'll be an independent contractor. And so none of the taxes are withheld from this type of finances. And so you have to plan ahead and prepare for this huge giant tax bill. A lot of people who are only 1099 employees will pay it quarterly. So it's not like you get this like bill for like $100,000 to pay in taxes. But just note that it could be different depending on what your employer situation looks like. All right, financial advisors. Everybody's heard of this before. There's several different kinds. The kind that I think everybody must have at least one time meeting is called a fiduciary. And the word fiduciary means that they have an ethical responsibility to act in the best interest of their clients. So if it doesn't say fiduciary, then they don't really have an obligation to do what's best for you. So I would strongly consider, especially early on in your financial planning, to find a fee only fiduciary planner who you pay hourly. So you're going to take 2 hours of their time, you're going to pay them for those 2 hours, and you're going to come up with a plan. And start off with that. Other labels you might hear are mutual fund rep, insurance advisor, personal banker. Those are other options. But just as a reminder, because everybody has that one friend they went to college with who's now in finances and doing very well. This is a business relationship. This is your accountant. This is your mortgage loan rep. This is your contractor that's fixing your house. This is a business relationship. So this is not friends. They make money off of your money. So just keep in mind that it's business. Okay, so for financial planning, as I said, my recommendation is to find an hourly fiduciary to get yourself organized. You're going to give them everything. You're going to talk about everything, concerns, the partner situation, any dependents. You're going to come up with a plan. Work on the plan. And then later, when you're organized and the plan is in process, complete, whatever, then you can consider other annual investments in stocks, plus or minus having a regular financial planner that helps you manage investments. But most of us don't need that right away coming out of residency. Like an investment advisor. And actually, regarding your finances, you might have several people. So you're going to have your fee-only advisor to come up with an overall financial plan, an insurance specialist to help you get adequately insured, a CPA to handle taxes, an investment manager leader, and then an estate planning attorney to make sure all your ducks are lined up for if something happens. Okay. So anybody who watches TV has seen insurance commercials. There's lots of options. Let's talk a minute about insurance. So we're insuring against the 4 financial catastrophes. So death, we use life insurance for that. Disability is disability insurance. Liability, so our professional insurance is our malpractice. And then personal insurance is the auto, home, umbrella insurance, which I will explain. And then our insurance against divorce is a prenup. And then everything else, probably most of us can self-insure. Like you don't necessarily need to buy insurance on a phone, an appliance. Those things are going to break down and most of us will be able to just buy a new one. We don't need the insurance on that. Any product from Amazon, don't buy those insurance products. You're just going to buy new. You're going to buy new. All right, life insurance. And so the life insurance you want is called term life insurance. And so that means that you are covered for a predetermined length of time. You decide how long it's going to be when you buy it. So it could be a 10-year policy, it could be a 20-year policy, it could be a 30-year policy, whatever you want. And once those 10 years are up, the life insurance policy is up. A lot of times there's an option to continue it if you want to, in which, of course, the monthly cost is going to go up. You can decide at that time. So typically the payments will stay the same for the length of the policy. So ideally, it's okay if your life insurance expires in 10 years because you're going to be investing in your retirement plan. So after those 10 years, your family, should something happen, will be able to use your retirement plan to replace that. So you only need the policy as long as it's going to need to be in place to replace you. I know it's a little bit morbid. Other types of life insurance. So there's whole life insurance and variable life insurance, and they're essentially the same thing. And you don't want them. So essentially what it is, and I'll go over it quickly because, if you're talking to a financial planner, this is something that they can make money on. And so they will try and sell it to you. So essentially what it is you have an annual premium or a monthly premium, and it's going to pay out no matter what when you die. So there's no term. It is for your whole life. But basically for that amount of money, for every use of whole life insurance, there's going to be a better way to invest that money for most of us who are not independently wealthy. And again, if you're listening to this lecture, for people that listen to my lecture on this, it's like they generally, this is not them. This is a link. And if you just search so WCI is White Coat Investor Whole Life Insurance. There's tons of articles on White Sox. But here's a little picture. Here's a little graphic. So as I said, if you pay this same amount of money somewhere else, so Ian is paying $300 a month into his whole life premium insurance, 35 years later, all he's going to get is $126,000 because of the way the policy is set up. Whereas Isabella puts this $300 a month in an index fund, and due to compounding interest, she has $1 million. So your money is going to be better spent somewhere else. Okay, one more slide on it, maybe two. So, the other thing about these policies is that the agents really want to sell you on it because they get a pretty big commission, like maybe $30,000 when they sell these policies. We get low returns back, or maybe just negative returns for many years. So what else can I do with my money? And I'm going to talk about some of this later. So you can max your retirement accounts. You can max the 529, which is the college savings plan account. There's a thing called a backdoor Roth IRA. So another place you can plug like $6,500. You can make sure your spouse has a Roth IRA if relevant. There's stealth IRA. There's a lot of other places to put your money that can compound that interest. And then the big key stat I think that really stands out is for people who buy whole life policies, 80% of people end up surrendering it before death. So it doesn't even do what it's intended to do. Okay, disability insurance. So, oh no, I can't go to work. He's disabled. Okay, so there's two types. Short-term disability pays out for a few weeks to a few months. That's how long it lasts. Usually I think pays out after like 6 weeks or something like that, and maybe goes to 3 months. Long-term disability starts paying out in that 3 to 6 month range. And then the duration of time you get it depends on the policy. It could be a couple of years. It could be all the way to retirement age. Just depends on what it says. If you work at a hospital, so like those of us at Loyola, and a lot of you guys who are at like the big group academic hospitals, you probably have a group policy, but it's not going to be enough to replace your income. So a lot of times it's about 50% of your income. And if you think right now, if something happens and you cut that tiny paycheck that you receive right now in half, like it's going to hurt, like it's going to be a problem. So we need to get an additional policy, and you want it to be an own occupation insurance policy. So what does that mean? It means that the policy specifically says, if I cannot do my work in your specific specialty, it can't just say physician, right? Because my family care doctor makes a lot less money than a urologist. So you want it to be very specific to your own occupation. And then it allows you to collect if you can't work in your job, even if you could like work at McDonald's, like again, not the same. So you want it to be very specific to your own job. Okay. Obviously, they want to make sure that you're reasonably healthy. So there are blood tests and medical questions. These are the agencies that specifically broker towards physician disability policies. You can literally just Google it. But this is where you're going to look for. The premium can vary depending on who you buy from. So, like my premium from Guardian and Standard was very different than Mass Mutual. Disability payout, so the money that you get is tax-free if you used after-tax dollars to pay for it, which is what most of the private policies will. Okay, so just thinking about taxes. And then for women, you want to get it before pregnancy because they are looking for any reason to not cover something. So for example, I got my disability policy between my first and second kid. My first kid was a C-section, and guess what? There is a rider on there that says any reason that I'm disabled in relation to complications from pregnancy is not going to be covered. Luckily, it didn't matter. It all worked out, but just you do want to get it before pregnancy. Okay, what is umbrella insurance? I hadn't even heard of this until I had like started doing research and after I finished residency. So this duck is drowning in your backyard pool. It's going to be relevant. Okay, so an umbrella policy, I know it's that. Policy picks up where your other policies leave off. So you have homeowners insurance, you have auto insurance, and then you have this backup $1 million umbrella policy. So you have to max your other policies in order to qualify or in order to get the umbrella policy. And then this duck has drowned, and now the family knows you're a doctor, and so they're suing you. And so there's an $800,000 claim against your homeowner's insurance. So your property insurance is going to pick up that first $300,000, and then the umbrella policy picks up the next $500,000. So you're covered. You don't have to sell your car. You don't have to make payments. Like you're covered. The umbrella policy is covered for it. And these policies are actually like pretty reasonable for insurance. It's obviously going to depend on your home and what your assets are. But when you compare it to the monthly amount for like disability insurance, like say disability insurance for like a reasonably healthy like person, I think my disability is like, I got it like several years ago, is like maybe 120 a month for my disability insurance. This $1 million umbrella policy might be like 200 for the year. Like they're very affordable, but you have to have your other policies max and have like big deductibles and all that. So other examples, why do I need an umbrella policy? Because you didn't shovel the snow or salt your sidewalk and somebody slips and falls, or in a car accident and they're like, oh my God, you're a doctor, you have lots of money, I'm gonna sue you. So there are reasons where it becomes relevant. Divorce. Okay, so this is I guess one option for a retirement plan at age 60. 65 will get divorced and marry people who planned better. I mean, probably not for everybody, but I guess that's an option. But divorce is financial catastrophe. It's so expensive. Choose your spouse wisely. Make sure that you have discussed financial status and goals before getting married. Consider a prenup agreement, especially if there's premarital assets, somebody owns a house, or there's previous marriages and or kids, just to make sure that everything is in writing and you both feel good about it. Divorce laws will vary by state, right? It's not like everywhere you can just instantly get divorced and file the paperwork and you're done. Some places have like a 1-year separation period before you can get divorced. Your finances are tied to that person you don't want to be with for all of this time. There are a few states that are fault divorce states. So if one person can prove the other person is to blame for the divorce, then like that one spouse that is not to blame will be favored. So it's not that straightforward. And I know this is uncomfortable. I know it's uncomfortable. Okay. And so partner topics for discussion. And again, you guys are like, a little probably good about talking about things, but like we're going to do some therapy. Okay. So I put my therapy glasses on. Here's some things to talk about. Do you going to have joint versus separate bank accounts? How much can the other person spend without having to discuss it? Because it could be variable. Some people are comfortable with 500. Some people want to talk if it's going to be over 200. What are our current financial obligations? Does somebody have a lot of other school debt, or they started a business and there's debt from that? How much debt is acceptable for us? When will you save for retirement? The answer is right now, but you should talk about it. How will you file for taxes, right? Are we going to file as a couple? Is it going to be head of household? It's going to change what that tax burden is. One more therapy slide. Okay. What kind of car do you want to drive? This one I put on there because I have a friend who married an orthopedic surgeon, and so they make a lot of money. She's a hospitalist, he's an orthopedic surgeon. They make a ton of money. They have no financial problems. But a few years ago, she sent me a text and she was like, why do we need 3 cars? Why do we need 3 cars? Our oldest child is 8. We do not need 3 cars. So, talk about it is what I'm saying, because he's like, I make a lot of money. I want a sports car. Just have a discussion, have a plan for it. How much money do you need to have access to in order to feel comfortable? If you're going to have children, are we going to do public school or private school? How important is saving for college for us so we can budget for that? Are you comfortable with the salary differential? What if that differential changes? Okay, so this is like, premarital counseling, like things to hopefully make sure you guys are on the same page. All right, here's a little quiz. In person, people shout the answers out loud, but you can just, think in your head. It'll be a safe space place. Okay. So what kind of life insurance do you want? You want term life insurance. And then you can ladder your policy. So you can actually have more than one policy, even if it's with the same agency, but one is like a 10-year policy. And then that one's going to run out and I'm going to have this much saved for retirement. And then you can have another 20-year policy after that. So you're not paying on the 10 anymore, but you still have that 20-year policy in place as your retirement savings increases. Okay. Ladies, you need disability insurance before pregnancy. Okay. Divorce is fun, true or false? This one's a little bit easy. It's false. It's not fun. Look at all these not fun divorces happen. So you really want to have finances in your planning before you get married. Okay, moving on. Loan consolidation and refinancing. Consolidation, pretty much everybody knows what these terms are, so I just kind of touch on them briefly. Consolidation is where you take all your loans, you put them together and you lump them into one big payment. Now it's harder to forget to pay it. Okay. The only caveat with that is that not all of your own loans will be eligible, and they will combine the interest rates, right? So if loan A is really big and has a really big interest rate, then maybe you don't want to combine it with loan B, which has a smaller interest rate. Okay. So you just want to look at the numbers. Refinancing is where you have a company buy out all of your loans with the hope of giving you a lower interest rate to get things paid off faster and overall pay less over the life of the loan. So that might be something to consider too. So PSLF. So everybody, again, is usually familiar with this, the Public Service Loan Forgiveness Program. This is best for people with tons of debt, or especially going into low-paying specialties. So something to consider if your medical school loans are more than 2 times your anticipated annual income. Okay, so primary care, pediatrics are usually the big ones. You have to work at a qualifying location. There's paperwork to file. It's really annoying. You have to, if you're on the phone with the government. But if you have a lot of loans, you could save several $1,000s by just putting in the legwork. A lot of residency programs will count to start with your 10 years of payments. So the earlier the better if this is something you think you need. Real quick on buying a house. So good goal is to aim for a mortgage about 2 times the household income. You don't really want to do much more than that, or you kind of risk being house poor. So you can have a conventional loan, right, which is the loan that most people do, with 20% down. And this is almost always going to be the best choice, is using this conventional loan. The interest rates are better. Your equity is going to be better. This is almost always the best choice. If you're only going to be somewhere for a short term, just for a residency, you're only going to be there 3-4 years, like obviously do it cautiously, because that might be too short of a time for it to be financially reasonable. Okay, real quick on the physician loan. So this is a loan that we have access to as doctors. The pros are there's no mortgage insurance, right? So for if you don't put a certain amount down, don't have a certain amount of equity, some places will make you get mortgage insurance. So you're paying an extra like couple hundred a month just in case you default on your loan. The bank has some security. Another pro for the physician loan is no down payment. You could literally just straight up zero down payment. I mean, usually paying some down payment is going to be beneficial, again, for your overall equity, but you don't have to. They will look at this and give you a higher loan amount. They don't count your student loans like as like totally as like being that much in debt. They kind of recognize that student loans, we all kind of have them. It's fine. And then for the physician loan, they'll look at your contract and they count that as a job. They're like, sure, you don't have the money yet, but you're going to have money. It's fine. So those are the pros for it. The cons are it's the same, no down payment. The down payment is actually beneficial in giving you some initial upfront equity in your house. I think there's risk of buying too much house, and obviously you're putting yourself into more debt. So things to think about. All right, compound interest. I have a nice little graphic. So unlimited power, not quite, but it's like pretty good. So what are our goals for retirement, right? You want to save for financial independence. Like nobody wants to work forever. You want to eventually be able to quit working at some point and just be free to do what you want. So with longevity at this point, you want to plan to sustain yourself for 20 to 30 years. Normal people who come right out of college and hit the gate running into an actual job, which doesn't happen that much anymore, but in theory, it should, can just save 10 to 15% of their gross income annually. But we started later. We have less time. So we want to shoot for 20% of our gross income. Hopefully your retirement income needs will be lower. You'll be settled. You won't have as much to pay for things because you'll have some of that financial security by investing in your retirement. And then maybe like Social Security will still exist depending on what happens with the government. Who knows? So this is a nice little graphic. Let's assume you make a salary of 200,000. You're putting 40,000, 20% into your retirement. You're gonna do this for 30 years, just straight, no changes, everything's good. It just goes away. You don't think about it for 30 years. Returns percentage is an average of 7%. That's gonna be $4 million because of the compound interest. So it just gets more, and that gets added to the interest every single year. And that's a decent amount of money. So you've heard this before. This is not the first time you've heard anybody say this, right? Start saving for retirement early. The earlier, the better. Even getting a little bit in there makes a difference. Okay, another ways to think about your retirement contribution. We're going to get a little bit into the nitty gritty here. Another way to think about it is when do you get your tax break, right? You have to be taxes like death and taxes, so I don't know, part of life or something like that. So here's a little graphic. You can either have pre-tax tax break and after-tax tax break. You can have investment gains. So anything that's invested is growing, and I like call that free money. Or you're lowering your taxable income or getting a deduction. Okay, so let's look at that. So pre-tax retirement accounts. This is money that is not yet taxed going straight into a retirement account. This is your 401k, your 403b, your 457b. And hopefully your residencies are offering you one of these. They're all the same. It's essentially 401k is a private company, 403b is usually a nonprofit, 457b is a government. They're all the same. Okay, same idea, essentially. And so this is reducing your taxable income. So you reduce your taxable income by the amount that you contribute. So they just, if you put in $20,000, they're like, you made 20,000 less. That's how the government sees it. So there are limits. The 2023 annual employee contribution limit is $22,500. The employer can match it in the account to get up to 66,000. Yeah, it's contributed to the account. You're going to pay, you haven't been taxed on this yet. This is pre-tax money. So you're going to pay taxes when you withdraw the money. But if you do it in retirement, When you have minimal income, you will hopefully be in a lower tax bracket and therefore be taxed less on it. Okay. These accounts should be invested, and investment choices can vary. So it's just going to depend on what your investment choices are, depending on whatever the company is. Okay. Tax brackets. Have you ever thought about this? Have you looked at them? They're fun. Okay. So if you're single, probably your resident salary is somewhere in here, right? So your annual tax rate is going to be $22,000. If you are an attending, head of household, or not married, basically, probably most of us are going to be somewhere in this range. And so you can see the tax rate goes from 22% to 35%. So that is a lot more money that the government is taking with you. And then you get married, or I got married a couple of years ago, and then my tax bracket went down here. I'm like, oh, this is nice. I get so much more money back. It's lovely. I mean, I didn't get married just for that, but it was like a nice little benefit. Roth IRA. Okay, so this is finessing your taxes a little bit, right? So a traditional IRA, the contributions are tax deductible, but because you haven't been taxed on it, when you withdraw the money, it's taxed in retirement. Okay. A Roth IRA, when you put in money, the contributions are not tax deductible. So you're not changing your gross income amount that's seen by the government. But if you withdraw the money in retirement, then it's tax free. And any gains that have also happened during this time are also not taxed. So we're back to the free money. Untaxed gains is free money. Okay. So that's why a Roth IRA is nice. As an attending, so there are financial limits to this, right? So I don't think I have it on the next slide. Okay, I don't know. You can look it up, but you can't. Not everybody can open a Roth IRA. There are limit maximums, and everybody, all of us as an attending, are going to be over that Roth IRA maximum. There's a way to get around it as an attending, where you open a traditional IRA and then you immediately convert it to a Roth. I don't know why they do that, but it's a little backdoor like tax trick. Get help with it the first time if you're interested in doing it. You don't need to do it as a resident. It's more like as an attending. Okay, so Roth IRA, this is after tax dollars. So you've already been taxed on it, and then that money is never taxed again. You can contribute up to $6,500, and then again, not taxed when you withdraw the money. Doesn't count as income. If your employer has a matching, so 403B matching, if you put in this amount, then you should do that. But if your employer does not have a matching retirement account savings account, then residents should fund this over pre-tax retirement account. So you're going to take it with you. It's going to go with you as a break. You again want to make sure it's invested. Okay, it's not just sitting there like a savings account. You want it to be invested in something safe. Okay. Okay. So again, just a visual to kind of explain. You either with the traditional IRA, you get your tax break now, and then you'll pay taxes on it later. With the Roth IRA, you're in a lower income, the money's already been taxed, and then it's just going to grow free over that amount of time. Okay. You're in a lower tax bracket now. As residents, this is why you want to do the Roth IRA now, is because your tax bracket is lower than it will be as an attending. Okay. 529, what is it? It's a college savings plan, usually for children. Contributions are not tax deductible, but some states do offer an income tax deduction for your state taxes. Okay. Growth is tax-free. There's no capital gains. Again, free money, yay. And if you use it to pay for appropriate college expenses, then you are also not taxed on it. You don't have to have children to open a 529 plan. Literally, all it asks for is a social security number. So if you are pregnant, you know you're going to have kids. You know that like no matter what, at some point you're going to be a parent to a child, or you have like a niece that you're very much fond of. You can all use a social security number to open up a 529 plan. You can use your own social security number and then convert it to somebody else's later. Okay. And it's not going to change the money that's in there. So it's just a nice little place to plug some money. A note on paying for college, you have to pay yourself first. So you need to make sure that you are taking care of your own retirement needs, because you cannot get a loan for retirement. Kids can also always get a loan for college, but you can't, nobody's going to give you money for a loan when you're 60 years old. They're like, you're not around too much longer. So no, you want to be able to pay yourself first. Okay. This is a graphic that just shows that different states offer different benefits. Okay. So I think the Illinois maximum, I don't remember what the number is, 7,500 or something like that, like up to that much contribution a year. And then after that, there's no benefit. So some people will have two plans. You see Utah all over the place because their college, their 529 plan has low fees. And so you're not paying as much. But it's just something when you're looking into it, you've got options. Other places for money. So flexible savings account, right? And so when they're talking to you about benefits, you've probably heard some of this stuff, right? So there's a healthcare savings account, which is triple tax free when used to pay for healthcare expenses. So it's pre-tax money. The money can grow over time. And then if you use it to pay for healthcare expenses, you're not taxed on it either. So this is a really nice place to just plug some money. Oftentimes these accounts will roll over from year to year. I could not do this as a resident because you have to have the high deductible healthcare plan, and I couldn't do that deductible. But as an attending, it's a nice option because I can front that higher deductible a little bit if I need to. There's also dependent care flexible savings accounts. So for children or dependents, if you've got other dependents, you can pretty much use that chunk of money to pay for anything that they might require as far as like babysitting. So they'll take summer camp, it can be a nanny, it can be preschool, and that money is pre-tax. You're not taxed on it. You're not taxed on it when you use it to pay for appropriate expenses. Usually you have to spend that annually. So you have to do a little bit of guesswork. So again, reducing your taxable income. And then there's also so you've got the healthcare savings account. There is also a healthcare flexible savings account. You have to spend that every year. I mean, some people can use it to like buy Band-Aids, right? So but you have to spend it every year. It's just another place to put pre-tax money. Okay, so real quick, what did I do? So here's my loans. My loans were actually not that bad. I had some scholarships and I went to an in-state school for me. So these were my loans coming up. I had to get this Wells Fargo private student loan because my car died. And this was a primary care loan because I knew I was going to do fellowship. And so I had this nice little 5% tax rate. And you can see, again, what did I figure out? I previously had a column here that was my grace period. So when do I have to start paying? So when I finished medical school, I had my nice little column. I need to start paying this in September of 2011 or whatever it was. And then my monthly payments. And then where are we at now? So you'll notice all of my loan names have changed. So all three of my main loans were bought by other loan companies. And so it's again, just keeping track of the madness. Okay, this became this became this, but the initial amounts and the interest rates were the same. This was my approximate monthly payments. This one's paid off. All right. This one I have an asterisk next to you because with the loan suspension for COVID, I literally paid nothing. I just did nothing. I put all my money into other places, and I was like, maybe student loans will go away. It didn't work out, but that's okay. It's gonna be fine because there was no interest, and I was able to pay down quite a bit on my other one. So that's what I did. Mistakes that I made. I deferred everything during residency. I didn't think about finances hardly at all, except for getting bills paid. I didn't start PSLF, which I probably should have done. I did have some credit card debt. I had my car died at the very end of medical school and the very end of residency. And I had to replace it. I had to replace that car. I have a partner who's a spender and, he's great, so great about so many things, but money is not one of them. The trade-off is he lets me do all the finances. He tells me if he's buying anything over 200, so at least I'm aware of it. And that's it works for us. Okay, time to adult a little bit. I like this one because it does feel very much like this is very overwhelming, and somebody come pick me up because it's too much. It'll be okay. Action items. Do I really look like a guy with a plan? No, it's gonna be fine. Okay. So things to do. Figure out your monthly expenses. If you don't already know them, figure out how much you're paying for food. Figure out how much you're paying for utilities. How much are you spending on fun things that maybe aren't necessary? Make a budget. You can do like pen and paper, old school spreadsheet if that feels good to you, an Excel spreadsheet. The YNAB stands for You Need a Budget, and it's just some digital software that can help get organized. Mint is another digital software option. And for both of those, you can actually pull in your bank accounts and pull in your credit cards. And then it will just upload it for you. It'll be like, this is how much money you spent on food. And it can give you a nice little pie chart to help you see where your money is going. Okay. In general, the recommendation is to save for 3 to 6 months of emergency expenses. If your spouse has a questionable job income, maybe you want that to be a little bit higher, but 3 to 6 months is the goal. Actionable items. Make sure you know your loan info, make a spreadsheet so you know when you're going to have to start paying for things. You don't want to be late on loan payments. So I recommend the total loan, the interest rate, and the grace period, because the higher interest ones you're going to want to pay down on sooner, right? Make sure you leave some room in the budget for fun things because we got to live. But really, this is the big one. Figure out your monthly expenses. Plan for your life insurance and disability insurance before residency. You know, the younger the better if you have to do medical tests. The thing about disability insurance, doing it before the end of residency, is that sometimes it's harder to get a policy if you already have a group policy with your job. They'll see like, oh, you already have group disability insurance. You don't need this. So you want to do it right before you get out of residency when you're not yet covered and you don't have that attending salary yet. Okay. But just put something into a retirement account. Just give me anything. Just anything. It can be a Roth IRA, it can be a 403b, whatever you have access to, but just put something in there. Okay. So it can start compounding. If you're going to do PSLF, just start it now. I know. Just take a weekend, the whole weekend shot, take your one day off, and then just do it and get it started. Okay. You know, they recently made changes in the last year about the federal loans. And so everybody's going to want to do the SAVE plan. They've just tailored it. So that's going to be the best one. It's income based, but it takes into account your actual available income, and it takes into account your dependents. And so everybody's just going to want to sign up for that one. Okay. Final thoughts. So again, this White Coat Investor website, it can be overwhelming, but it is fairly accessible. And there is something called Intern Financial Survival Guide. And so this is geared towards doctors. And the whole process that we go to, high student loans, making no money for several years, and then making a lot of money. So there's the Intern Survival Guide. There's also, I think I'll talk about it later. There's also like literally a button on that website that says start here. Or it's like the 10 web pages for financial basics. So again, it's very approachable. You can go down a rabbit hole. It's easy to go down, you know, but really you guys have no reason to already know this stuff, right? You should not feel overwhelmed in the sense that like, what am I doing? There's no reason you should know this, right? You know about heart failure, you know about psychiatric disease because you've studied it. You're exposed to it. You read papers on it. So do a little financial CME, right? Spend a little bit of time reading about it so you get more comfortable with this. Consider a digital budgeting program, 3 to 6 months emergency fund. Again, I already said that. Financial CME, read about it. Just spend like 15 minutes a month adding to your financial literacy so you're getting more comfortable with those things. Just make sure you consider all the facets of consolidation before doing it. You get a lot of emails about it, but consider it first. Pay yourself first. And I'm talking about retirement, like not in tacos, like tacos, we talk for tacos later. I'll get to the chat in a second. You know, you could do it. I know it's a lot, but you could do it. If you can save lives, you can manage your finances, right? Sometimes I'll literally be doing something. I'll be like, I could do this. I'm a doctor. Same thing. You could do it. So I said whitecoatinvestor.com. Like again, there's a page that says start here, beginners. Here's a few books if you're a reader. The Millionaire Next Door. A little bit old school, but still has a lot of good concepts in it. My financial advisor likes this the investment answer he liked a lot. All right, questions. So the two in the chat. Do I recommend any